Something big is happening in the U.S. job market, and it's the kind of news that makes the Federal Reserve lose their mind. Fewer jobs, rising unemployment, and paychecks do not stretch as much as they used to. Now what? Well, rate cuts are almost guaranteed. And let's break it down so that way we know what to do with this information. Hello, everyone. My name is Daniel Dominguez. I keep an eye out on the numbers, that way you don't have to. August job reports came in and the economy is looking a bit different than what we thought it would look like. Let's talk about what's actually going on and what this means for you and your money. Job growth misses big in August. The economy only added 22,000 jobs compared to the 75,000 it was expected to have created in August. Now, here's the kicker. In recent months, jobs have actually been reconsidered or revised downward. For example, in June and July, jobs were expected or were said to be at 147,000 new jobs created. However, after the revision, they actually found out that negative 13,000 jobs were created. So a net negative loss of jobs, which basically means that the job market is cooling faster than what we expected or what the government expected. We're seeing unemployment creeping up, only went up by 0.1%. So it went from 4.2 to 4.3% unemployment in August, which doesn't sound like a lot, but to the Federal Reserve, any little thing, even 0.1%, is a flashing signal to where the economy is going. And that to them signals that it is loosening. And so that will influence their decision moving forward as to what to do with the interest rates. Now, let's talk about wages. Everybody wants to talk about their paychecks and what's going on with it. Well, we actually have seen an increase of 3.7% in wages compared to this time last year. Now, that sounds nice and everything if inflation wasn't around 5%. Because inflation is higher than the increase in wages, that translates to your paycheck actually buying you less than it did a year ago. In fact, if you're not making a 5% bonus on your paycheck on top of the wage increase, you are actually negative in income compared to inflation. Now, we're seeing a lot fewer job opportunities. We are actually seeing a drop of job openings to 7.18 million, which is the lowest it's been in a year, actually. And the layoffs at this time have increased to 13%. And in some cities, like my hometown of New York, we've actually seen an increase of layoffs up to 200%, which is massive. Doesn't even make sense. So what's the Fed going to do in this situation? The Fed cannot ignore what's going on, and they cannot unsee the jobs report. So the markets have already priced in, before the job report, a 99% rate cut or chance of a rate cut in September. Now, after the jobs report, the market is basically making the rate cut a done deal. It's basically 100% guaranteed that there will be an interest rate cut in September moving forward. And at this point, it's not a matter of if they will cut it anymore. It's a matter of how much they will cut the interest rate. Will it be 0.25% or will it be a whole 0.5%? We will find out, which is critical to the fiscal policy moving forward and to investment properties and assets as well. Now, this is the big picture. What does this all mean? Really, rate cuts give businesses and borrowers a temporary break, right? But at the same time, it also puts fuel on the fire of inflation. Workers are actually the ones stuck in the middle. They don't see much of anything. Paychecks aren't really keeping up with the increase in expenses and the rising cost of expenses. And also jobs are getting harder to find. That's the truth. Now, why does this matter to you? This matters to you because rate drops usually make a big difference. They do one of two things. They do two things, actually. One, they allow buyers to suddenly afford more house. And they allow investors to finance bigger deals at lower costs. So even in a weak economy, real estate will still hold its value because people still need a place to live. And this is the reason why downturns actually end up being a great opportunity for buying assets and investments and buying a house for you to live in as well. So in conclusion, August we saw was a wake-up call for the economy and for a lot of individuals. The job market is slowing down and the Fed has to make a move. They can't not ignore the job report like they've done in the past. They have to acknowledge it. And so in the next 6 months or so, we are going to see some changes. We're going to see a lot of things happen, especially in the economy, either for good or for worse, but they're going to be critical either way. So yes, the labor market is softening, but for real estate investors, smart real estate investors, this could be a window to lock in lower financing and pick up a few assets that will allow you to set yourself up financially in the future. So the question isn't really, are you going to do anything or if the rates will go down or not? The question is, will you sit on the sidelines or will you position yourself for financial freedom? Thanks again for watching. Stay tuned, subscribe, leave a comment below, send this to somebody that you think needs to hear this, and let's keep making sense of the economy together.